Welcome to Griffonomics.
Glad to be here for this one.
Yeah, so today we are jumping into a deep dive on Builders FirstSource, ticker symbol BLDR. And if you've been tracking the construction space at all, you know things are pretty chaotic right now. We've got a massive stack of sources for you today. We're looking at earnings transcripts, financial models, strategic memos, basically everything we need to answer one really massive question for you.
Which is whether their current transition is actually going to work.
Exactly. They are trying to turn from a basic, commodity lumber distributor into this tech-enabled, value-added powerhouse. And we need to figure out, is this a generational buying opportunity? Or, looking at their debt and the contracting housing market, is this just a cyclical value trap?
I mean, it is arguably the ultimate corporate stress test on the market right now. You're looking at an organization that is fundamentally trying to change how America builds its homes.
Right.
But they're attempting this evolution while simultaneously getting just hammered by plunging earnings, a frozen real estate market, and a brutal new tariff shock. The tension between their long-term structural ambition and their short-term macroeconomic reality is, well, it's creating a massive divide among analysts.
Yeah, but before we can even judge the macro pressures crushing this company, we have to unpack what they actually sell. Because looking at the Q1 2026 data, the days of just dropping off stacks of raw 2x4s at a dirt lot, those are over. Almost half of their business, I think it's 48% of their net sales, is now coming from what they call a value-added product mix.
Yeah, and that 48% is basically the entire thesis for the bulls right now.
Huh.
We are talking about manufactured roof and floor trusses, prefabricated wall panels, custom millwork, fully assembled vinyl windows.
So not just wood.
Right, these are highly engineered, factory-built components.
Looking at this shift, it really seems like they aren't even selling lumber anymore. They're selling time. Like, if I'm a builder who can't find framing crews, buying a pre-built wall saves me weeks of labor.
That is the exact point.
Yeah.
That shift from selling a commodity to selling efficiency, it completely changes their pricing power. Because the single biggest bottleneck for home builders today isn't land. It's the severe shortage of skilled tradespeople.
Yeah.
When Builders FirstSource delivers a completed roof truss to a job site, a task that used to take a crew of carpenters, days to measure and cut and assemble, it can now be dropped into place by a crane in hours. Builders are highly motivated to pay a premium for that because it accelerates their timeline to actually close the house and get paid.
It's basically the grocery store milk strategy, just applied to construction.
Anyway.
Well, you come into the ecosystem because you need the cheap milk, right? The commodity lumber. But because of how the system is built, you walk out with the high-margin pre-chopped vegetables. And the sources show they processed almost $800 million, in quotes, in the first quarter alone through their digital platforms, Paradigm and MyBuildDR.com. But I do have to push back here a little bit. Corporate software in the construction industry historically ends up being kind of bloated fluff. Are framing contractors and local builders actually logging into a digital platform, or is this just, a flashy buzzword for their earnings call?
Well, the usage metrics indicate it is deeply embedded in the workflow. The strategy only works if the software actually solves a friction point for the builder. By offering estimating, 3D drafting, virtual design software, Builders FirstSource isn't just a vendor anymore. They become the architect's and the estimator's primary tool.
Oh, I see.
Yeah, so once a builder builds all their home models in the Paradigm software, moving to a competitor means starting completely from scratch. It creates a highly sticky relationship that prevents builders from purely price shopping for raw lumber.
Right.
Builders FirstSource can execute this turnkey bundling strategy where the digital integration and the value-added components make the whole package just, well, too convenient to walk away from.
Okay, so they build this incredible competitive moat with high-margin, highly engineered products. But here is the bitter irony that I saw in the memos. The very thing that creates their structural advantage is exactly what is exposing them to a massive new industrial headwind right now.
You're talking about the April 6th, 2026, Section 232 tariff amendments.
Exactly. The government imposed a 25% duty on steel, aluminum, and copper. And that is a direct, completely unavoidable hit to the most profitable segments of their business.
Yeah, because to build those time-saving products, you need metal. Manufactured wood trusses don't hold themselves together. They require stamped steel connector plates, custom windows, pre-hung doors. They rely on aluminum framing, metal balances, heavy hinges. But the thing that really stood out in the sources is how this tariff is actually applied.
It's wild.
It is. It's applied to the full value of the imported goods, not just the raw metal components.
Which brings us back to that imported hubcap analogy. If you import a fully assembled window and the aluminum framing triggers the tariff, you aren't just paying a 25% tax on the aluminum. You are paying a 25% tax on the glass, the vinyl, the weather stripping, the manufacturing labor of that entire window.
Right.
That is a massive cost multiplier. But, and here's my question, home builders are facing terrible affordability constraints right now. Buyers are just tapped out by high interest rates. Can Builders FirstSource really just force these massive price hikes down the builders' throats without losing the contract?
Well, CEO Peter Jackson addressed this head-on during the earnings call. He explicitly stated the company won't act as a charitable institution to solve builders' affordability problems at the expense of their own margins.
Wow.
Yeah, they intend to pass every cent of these costs through. But that mandate is resulting in what he described as hand-to-hand combat in local markets over pricing.
Hand-to-hand combat, what does that actually look like on the ground? Are builders threatening to walk away from half-built subdivisions?
It manifests as just severe friction in the quoting process, like a builder gets a bid for a lumber package that is suddenly 15% higher than last month. They push back, they demand requotes, they threaten to strip out the high-margin windows and source them locally.
Oh, man.
But the real issue for Builders FirstSource is the timing lag. In the manufactured truss business, the cost basis is often locked in during the initial quoting and bidding phase, which can happen months before the materials are actually delivered.
Right.
So when a tariff suddenly spikes the cost of those steel connector plates mid-cycle, Builders FirstSource has to eat that margin compression on all their existing, locked-in bids until they can slowly reset prices on the next round of community planning.
And we can see the bruises from that combat on their Q1 2026 financial statements, because the numbers are brutal. Adjusted EBITDA plunged 42.1% down to $213.8 million. Gross margins compressed by 220 basis points to 28.3%. Let's translate that for a second for everyone.
Please do.
A 220 basis point drop means that out of every $100 they bring in, they are keeping $2.20 less in profit compared to last year. That is a massive bleed for a distributor.
It really is. And a huge piece of that profit bleed is driven by commodity deflation. In Q1, average lumber prices settled into the $390 to $410 per thousand board foot range. The company cited a $120 million headwind purely from this drop in the cost of raw wood.
Wait, I need you to clarify this mechanic. If the cost of lumber is dropping, shouldn't that lower the cost of building a house?
You would think so?
Which should encourage builders to build more homes, which ultimately helps a supplier like Builders FirstSource. Why did cheap lumber cause a $120 million drag on their earnings?
It comes down to the unforgiving physics of operating leverage in a distribution business. Keep in mind, despite their shift to value-added products, about 37% of their base business is still directly tied to selling commodity lumber. Their pricing model for that wood is a direct markup on the underlying commodity market. So if the market price of lumber drops by 30%, Builders FirstSource's final selling price drops by 30%. They could sell the exact same physical volume of 2x4s, loading the exact same number of trucks, but the total top-line revenue generated from those sales artificially shrinks.
Let me get this straight. They are moving the exact same amount of heavy wood, doing the exact same amount of labor, but taking in significantly less cash.
Precisely. And they have massive fixed costs to execute that labor. They operate 570 locations nationwide and manage a fleet of 19,300 delivery assets.
Yeah.
When your top-line revenue shrinks due to the commodity market, but your fixed operational costs, the warehouse leases, the truck maintenance, the driver salaries, they remain exactly the same, your profit margins get absolutely crushed.
Man.
The physical infrastructure becomes an anchor. That dynamic is the primary driver behind that 42.1% plunge in EBITDA.
So the new build market is a bloodbath for them right now. Core organic sales for single-family homes dropped 11.1%. You've got operating leverage working against them with cheap lumber, and you have tariffs spiking the input costs of their premium products. I mean, if single-family construction was their only revenue stream, we'd be looking at a bankruptcy. So what is keeping this company from completely collapsing?
The answer is actually the sheer decay of the homes we already live in. The safety net is their repair and remodel segment, which is generally referred to as R&R.
Right. The structural statistics on this and the sources are fascinating. The median American home is now 44 years old. Financial advisors historically told people to save, 1% of their home's value for annual maintenance. Now, because the national housing stock is so incredibly old, they're telling homeowners to budget 2% to 3% annually for unavoidable upkeep.
Because when a house hits 44 years old, the repairs transition from cosmetic upgrades to structural necessities. A 44-year-old house is like a 15-year-old car. You aren't upgrading the stereo system. You are desperately replacing the transmission just to keep the thing running.
Exactly.
You have to replace the rotting window frames, the sagging roof trusses, the exterior doors, and you see the resilience of this necessity in the Q1 data. While single-family new starts plunged 11.1%, Builders FirstSource's R&R segment declined by only 1.3%, is acting as the ultimate financial ballast against the cyclical swings of new construction.
But Builders FirstSource is famous for supplying massive national home builders constructing entire subdivisions. How do they capture this highly fragmented market of local remodelers who might just be buying 3 windows and a door for a single house?
By pointing that exact same value-added digital ecosystem directly at the remodeler, remodelers are fighting the exact same skilled labor shortages as the big corporate builders. So Builders FirstSource offers the local contractor the digital estimating and virtual design tools to help them quickly quote a kitchen or a roof expansion.
Okay.
But more importantly, they offer professional installation services to actually get those complex windows and millwork installed. They're simplifying the most complex, labor-intensive parts of a renovation, embedding themselves as an indispensable partner rather than just a supply yard.
So with the safety net of the R&R segment keeping the lights on, we have to look at how leadership is actually managing their balance sheet through this trough. How are they allocating their capital when margins are under this much pressure?
Well, they're placing massive bets on their own survival. In the first quarter, management retired 3.3 million shares. They spent $303 million at an average price of $92.25 a share. And they didn't stop there. The board just authorized a brand new $500 million share repurchase program. Management is aggressively signaling to the market that they view the stock as trading at a tremendous discount at what they believe is the absolute bottom of the cycle.
Okay, I have to stop you there because the sources highlight a major contradiction. Management is buying back $300 million of their own stock, but due to the earnings slump we just discussed, their leverage ratio spiked. Their net debt to LTM adjusted EBITDA ratio hit 3.2x. To put that in perspective for anyone listening who isn't staring at corporate balance sheets, that metric measures a company's total debt against the cash it generated over the last 12 months.
Right.
Management's own stated safety target for that ratio is between 1.0x and 2.0x. Wall Street usually punishes companies for blowing past their leverage targets in a high interest rate environment. So why drain your own liquidity to buy stock right now? Isn't that incredibly reckless?
It's the primary point of friction between the executive suite and Wall Street analysts. During the Q1 earnings call, analysts from Bank of America and UBS actively pressed to management on this exact contradiction. From the analyst perspective, you have 3.2x leverage, a contracting housing market, and new tariff shocks.
Right. The prudent move is to stockpile cash and pay down debt.
Exactly. But management is looking at their structural evolution. They see the 48% value-added mix, they see the $800 million digital moat, and they firmly believe the market is severely mispricing their long-term earning power. They believe the current earnings are artificially depressed by the commodity deflation, and once lumber stabilizes, the top-line revenue will instantly repair that leverage ratio.
I mean, if you are going to run the business at 3.2x leverage, you have absolutely zero room for error. A single operational misstep could trigger debt covenants. They have to aggressively trim the fat everywhere else to survive this downturn.
Which brings us to their downturn playbook. They are hunting for operational efficiency anywhere they can find it. In early 2026, they consolidated 21 separate facilities to optimize their manufacturing capacity. They also outlined a massive productivity savings target of $50 million to $70 million for the full year, and they've already realized $6 million of that in Q1, primarily through supply chain and logistics initiatives.
Let's explore the logistics of that, because on the surface, closing facilities sounds counterintuitive for a distributor. If you consolidate 21 facilities, doesn't that mean your 19,300 delivery trucks now have to drive significantly further to reach the job sites? Doesn't that burn more gas and increase delivery times, effectively wiping out the savings?
It would, if they were just consolidating raw lumber yards. But this is about optimizing the manufacturing hubs for the value-added products. You don't need a massive truss manufacturing plant in every single zip code.
Oh, that makes sense.
By consolidating the heavy manufacturing machinery into regional mega hubs, they run the factories at full capacity 24 hours a day, maximizing the return on the equipment. They then use smaller, localized yards purely as distribution nodes. It's a hub-and-spoke model that drastically lowers the fixed overhead of running half-empty factories.
The sources also highlight a major technological shift happening behind the scenes, a massive SAP rollout, which is an enterprise resource planning implementation. But the CEO explicitly described this rollout as slow and incremental. Now, usually when a company talks about upgrading their tech stack, they hype it up as revolutionary, fast, and agile. Why on earth are they bragging to investors about being slow?
Because an ERP system is the central nervous system of a modern corporation. It controls inventory, truck routing, payroll, quoting, accounting, everything. A botched ERP transition is one of the most dangerous events a distributor can ever experience.
Oh, I bet.
If you rush a massive system integration across 570 locations and a bug freezes the system, you literally lose the ability to locate your own inventory or dispatch your trucks.
Hmm.
We've seen generic industry examples where rushed software updates paralyze supply chains for weeks, costing hundreds of millions in lost revenue.
Wow.
So in a tight housing market where builders are fighting for every single dollar, going slow to protect operations is a strategic necessity. They successfully converted central accounting in 2025, they're testing the supply chain modules now, and they refuse to accelerate the network-wide deployment until 2027. It is pure risk mitigation.
Well, if you are looking at this company from the outside, trying to weigh these competing realities, the divide is incredibly stark. On the bear side of the argument, you are looking at an organization facing a 42% plunge in earnings. They just got hit with a 25% full value tariff shock on their most profitable products, and they are leveraging the balance sheet past their own safety limits to buy back stock. To a skeptic, buying at the current 52-week low looks like catching a falling knife. It feels like a structural valuation re-rating and a classic value trap.
But the bull thesis requires looking past the immediate cyclical pain. The core argument is that Builders FirstSource is no longer the company it was a decade ago. They have successfully maintained a 48% value-added mix, creating products that home builders desperately need to offset a permanent labor shortage.
Right?
They have a digital platform processing massive volume, and they have the repair and remodel segment acting as a reliable shock absorber. If you believe in that structural transformation, then management's decision to authorize $500 million in stock buybacks at the cycle trough isn't reckless. It is a masterstroke of capital allocation.
It really hinges on your belief in their pricing power. If you believe the builders simply cannot afford to absorb those tariff costs, the margin compression will become permanent. But if those labor-saving trusses are truly indispensable, the bundling strategy will eventually force the market to accept the higher prices once the bidding cycle resets. It's a fascinating standoff between brutal macro headwinds and relentless micro-execution. And it leaves you with a final, unmentioned thought to ponder long after we wrap up this analysis. Think about that digital platform paradigm processing nearly $1 billion in quotes in a single quarter. They are capturing incredibly granular, real-time data on exactly how, when, where, and with what exact materials America is building its homes. As they begin to roll out embedded AI tools later this year, could Builders FirstSource eventually become more valuable as a predictive data and software platform than as a physical distributor of lumber? It is absolutely something to watch. Risk defined. Portfolio protected.